Right, I think we will start. A very warm welcome to everyone joining us from all over the world today. We're going to be talking to you today about the UK budget, the recent UK budget that happened a few weeks ago, and what this truly means for property investors. There's been a lot of hype, a lot of noise about this budget, lots of different policies being introduced, and what we're going to do today is break that down for property investors and exactly what it means for property investors. So we'll get started. My name's Sanjit Danja. I'm the Managing Director of Opulent Investments, and joining me today is Ben Lane. Unfortunately, Ben Lane's having a few issues with his camera today, so you might not be able to see him, but you should be able to hear him.
Thank you very much for having me, Sanjay. And to be honest, that's probably the best, isn't it?
It's probably a good thing you can't see his face, but there you go. So a little bit about us before we start. We're Opulent Invest. We're an award-winning property investment company. We've been around now for well over 10 years. We've got hundreds of investors, and we've sold well over £1 billion of UK property. Agenda for today. We're going to talk about the key changes within the budget. We're going to home in on stamp duty, because I think that's the big one that everyone wants to know about, and the one where our property investors have been affected the most. We're going to touch on taxation. Although we're not tax experts and we're not qualified to give tax advice, what we will do is just talk very briefly about the changes to the taxation and how that affects property investors. We're going to talk about affordable housing, because there was a big drive on affordable housing from the Chancellor in her recent budget. We're going to talk about what that means for property investors and whether that helps or doesn't help. And then finally, we'll summarise the key takeaways from the UK budget. And then the second half of the webinar is very much going to be about a very exciting new launch we have here at Opulent. We're going to run you through that project. We're going to show you a video of that project, and we're going to give you the key investment highlights of that project. And then right at the end, we will have a Q&A session. Feel free to ask us questions throughout this webinar. We will endeavour to answer them at the end of the presentation. Just before we get started, it's always very, very useful for us to know who we're talking to and who's attending our webinar. So I've put up a quick poll, which you should be able to see on your screen. Let us know who you are and what describes you best. That would be very useful. So let's get started. Before we go into the budget, we're going to just have a quick chat about the budget and what was happening in the run up to the budget. There definitely seemed to be a lot of anticipation on this budget. The Chancellor has effectively got a £22 billion hole that was inherited from the Conservative government. And so we were all expecting a number of changes to the budget. Ben, I'll bring you in here. Ben, you speak to a lot of our clients all the time. I know from our perspective, there was a lot of anticipation. About a month before the budget, there was very little activity. A lot of our investors were sitting tight, holding tight, and just waiting to see what was going to happen. Tell me a bit about your clients and how they were feeling about the budget.
Exactly, definitely. Because I think as you were saying, in terms of anticipation towards the budget, it was kind of fearing the doomsday kind of scenario where there'd be a complete raid on the sort of rich and kind of anyone who's kind of aspirational, looking to provide and save for their future. But I think the kind of response to the budget after it, I think it's definitely been, it wasn't anywhere near as bad as people thought. I think there's obviously there's a lot of painful kind of certain groups. So if you're an employer, for example, obviously the rise in national insurance. Obviously, if you're a farmer, then the changes to the inheritance tax regime and so on and so forth. But I think generally it's been nowhere near as bad as people thought. And also from a property-specific perspective, actually, whilst there's obviously the changes in stamp duty that we'll come on to, compared to other investments, is actually now probably a more attractive investment opportunity that we'll come on to.
Absolutely. So in amongst all of the changes the Chancellor announced, there were some that affected property investors. And what we're going to talk about now is the key policy that will affect our investors. We're going to talk to you about how that impacts you in the various different ways. And then what we're going to also do is look at strategies that you as investors can employ to help mitigate any changes and how they affect you. So the first one, and perhaps the biggest one, is the increase in stamp duty for buy-to-let investors. And this is often known as the higher rate for additional dwellings. Previously, we as investors would have to pay a 2% premium for all of the properties that we purchase. That's now gone up. It would have been, it's now in 5%. It's now 5%. That it was 2%. It's now 5% that investors have to pay. And we're gonna also talk about, in detail how this affects us. We're going to run you through an example to show how that affects people financially. We're a bit later on. And we're also going to talk briefly about the first-time buyer stamp duty. Currently, any first-time buyer who buys a property up to 450,000 was stamp duty exempt. And that's still the case, but that's due to change also from the 1st of April next year. And that threshold of 450 is due to come down to 300,000. We're going to talk to you a little bit about tax, as I mentioned, capital gains tax. I think the key takeaway here is that for property investors, capital gains tax actually remains unchanged. We'll touch a little bit. I don't want to talk too much about inheritance tax because, again, it largely remains unchanged unless you're a farmer and own an estate in excess of £1 million. You'll then be liable for inheritance tax on the amount above £1 million. And then finally, Ben's going to talk to us a little bit about affordable housing, the measures the Chancellor's taken around affordable housing, and then what that means for you guys as property investors. So let's talk about stamp duty, because after all, this is a big one. The changes the Chancellor made came into effect almost immediately. So as you can imagine, there was a bit of a frenzy amongst our investors, certainly the ones that were already going through on properties. Effectively, if they weren't able to complete on that day these changes were announced, then they would have had to have paid more stamp duty. So it's a bit of a frenzy trying to get whatever deals we could get through across the line. But anyone who couldn't make it, unfortunately, would have to pay more stamp duty.
And I mean, they only gave us about 12 hours to do it, so it was definitely a rush that morning.
It certainly was. It certainly was. So let's look at the stamp duty rates as they stand currently. Up until the 31st of March, the stamp duty up to 250,000. This is for non-investors. The basic rate was 0% up to 250, and then the next 675,000 between 250 and 925, we pay 5%, and then 10% and 12% and so on. From April the 1st, 2025, up to 125,000. We pay 0%. The next 125,000 between 125 and 250, we pay 2%. This is for end users, by the way, not investors. Investors do have to pay a premium. The next 675,000, we pay 5%, and so on. So the only difference here, really, for first-time buyers and end users, is the thresholds have now reduced for first-time buyers. So I'm going to go back to the previous slide now. In the main, Ben, talk to us about how the stamp duty changes are going to affect our investors.
Yeah, of course, absolutely. So, I mean, I think, if you're buying a kind of more expensive property, say, kind of 300,000-400,000, then obviously you're paying that extra 2%. So you're paying, if it's 300,000, extra 6,000. If you're paying a £400,000 property, you're paying an extra 8,000. Mm-hmm. So I think, it's obviously a bit of pain at the start, but obviously you do have to take a a kind of more medium to long term view when it comes to buying properties, and also, which is the mantra that we've been saying, is definitely looking at properties which are maybe slightly lower in value, because in the end, a £2,000 increase on a lower value property is not going to be as large a kind of difference compared to the more expensive properties where you have lower returns.
Absolutely.
So that would definitely be my...
In fact, I'm just going to go on to illustrate this for you guys. Ben's made a very valid point, and we'll talk a little bit more about this as we get to the strategies. But here we have an example on your screen of a typical £500,000 property, and what investors would have paid before the 31st of October. We would have paid 3% on the first 125, so 7,500, and then 7% thereafter. In total, if we, as investors, had bought a property of £500,000 before the 31st of October, we would have paid in total £25,000 in stamp duty. If we look at the period in between now, the 31st of October, when the changes came into effect, up until the 1st of April, which is when the next set of changes are going to come through, then as you can see here, we pay an extra 2% on the first bracket. So instead of paying 3%, now we pay 5% on the first amount. And then thereafter, instead of paying 7%, we now have to pay 9%. So in total, our stamp duty liability, literally over the span of 24 hours, has gone up £10,000 when you're purchasing a 500k property. Now, let's fast forward to the 1st of April, when the revised tax bands come in, the revised thresholds come in, then we're actually paying now considerably more, an extra £5,000. So in total, if you're buying a 500k property, your stamp duty liability has gone up from 25,000 until next year, you're going to be paying 40,000. That's quite a significant hit for our investors, and we will effectively, investors will have to stomach that, guys. There's not a lot we can do about that. Tax is something we all have to pay, it's usually payable straight away as well. So that's on a 500k property. You can see the impact is £15,000. Now let's look at 125k property. This particular property, before the 31st of October, we would be paying 3,750, a flat 3% on the 125,000, which equals £3,750. Nice and simple. Now let's look at between 31st of October and the 1st of April. We're now paying 5%. The difference is £2,500. We're paying 6,250, and even when the revised thresholds come in, we're still only paying 5% because the price of the property is only 125,000. So as you can see here, irrespective of whether we're investing today, after the 31st of October, or after the 1st of April, what you'll see here is that when you're buying £125,000 property, the difference you pay in stamp duty is only 2,500 in comparison to 15,000. And so what Ben mentioned earlier on is actually a very, very useful strategy. In light of these changes, we as investors, we need to focus on lower value property. And that way you're all paying less stamp duty. So how does this affect us as investors? First of all, your higher acquisition costs. Obviously stamp duty factors in as an acquisition cost. You're paying more stamp duty. Your purchasing costs are going to go up. Potentially a lower return on investment also, because obviously you're paying more in stamp duty, your outlay is more, and so you could have a lower return on investment, particularly if you're focusing on those higher value properties. And what some pundits are saying, Ben, is that the buy-to-let market may contract as a result of it.
Yeah, exactly. And I mean, again, it kind of depends on the area, because again, it depends how punishing the stamp duty is. So yes, again, in terms of how to kind of mitigate these, that kind of risk, again, if you're looking in areas where prices are relatively low, where the increase in stamp duty will not really affect your overall return over a long-term period, then those are going to be the areas that aren't going to be affected. Whereas your kind of higher end, more expensive properties are definitely going to be the areas where you might see some contraction as the returns are just less attractive.
Absolutely. So what can we do what can we as investors do to kind of counteract this? Well, the first thing we've already touched on is to look for properties in emerging markets or property prices that are cost effective. We're going to talk to you a little bit more later on about the Northeast, but the Northeast is a prime example. It's an area that's been deprived of funding. Prices are low, but now we're starting to see evidence of lots of money being spent in the area, and we're seeing areas of the Northeast transform. So tip number one, look for properties that are in emerging markets where you can buy low and sell high. The next thing you can do also to minimize the cost of the stamp duty is look to invest with a friend or a family member. If that's possible, create a joint venture with someone else. Another thing we can do, now this doesn't necessarily affect the stamp duty we pay, but what it will do is affect your resale value, because by purchasing the property in a company, effectively, when you come on to selling that property on to someone else, you can sell the company as opposed to the property and do what we call a share purchase acquisition of the company. And in that scenario, the person buying the property from you will only pay 0.5% as opposed to the increased stamp duty rates announced by the Chancellor. So that's what we can do. That's stamp duty. There was a lot of noise about this, and we definitely fielded a lot of inquiries, a lot of nervous clients. And initially, when these changes came in, they were feared, and a lot of people a lot of people were panicking. But actually, when you now that the dust settled, and when you look through all of these changes, yes, they can be quite significant if you're looking at the higher end of the market. But if you're an investor and you're aiming at the sweet spot of between 125 and 200,000 for a property, then the changes are not as significant. So yeah, plan ahead, do all your numbers properly, make sure you know exactly what you're paying. And if you can do that, then the chances that these new changes will unsettle you will be relatively slim to none. So that was the first big one. This one, kind of also related to taxation, is taxation itself, and in particular, what we're talking about here is capital gains tax.
Yeah, exactly. And the thing is with capital gains tax is that traditionally property has actually been much higher compared to other investments like stocks and shares, and obviously kind of selling businesses and that kind of thing. But actually, all that's happened is that the basic rate of 10% for assets like stocks and shares and that kind of thing has actually been increased to 18. And then the high rate of 18 has been increased to 24. So all that's happened really is that other asset classes have just been brought in line with property.
Correct.
So what that means is, as a property investor, this basically remains completely unchanged. The only difference really being is that property is now actually a more attractive asset class from a taxation perspective compared to these other assets.
That's right. And all those investors that were looking to sell quickly as a result, before some of these changes come in, then you may not need to do so now. And so, as Ben quite rightly mentioned, the picture remains largely unchanged for property investors. Again, there was talk of capital gains tax going up. But look, let's face it, ultimately, the Chancellor here needs to get the economy going again. And so, the idea was she wasn't going to tax property investors anymore.
Yeah.
So that's capital gains tax. In terms of what we can do, I mean, there's not a lot we need to do really, but these strategies are kind of strategies that we as investors should be employing the whole time.
Yeah, exactly, absolutely. And I think definitely always taking a long-term view, or at least a kind of medium to long-term view, is always the best way. Because I'm still, surprised with how many clients I get who, even with the changes in stamp duty, believe that, can I just buy the property and then sell it within 2 years? And, unfortunately, at the moment, you're probably going to be paying at least 1 or 2 years worth of rent in the stamp duty alone. Mm-hmm. So as long as you take a medium to long-term view, hold the property for at least 5 years, preferentially 10 to 15 years, that's where you make the big money from property. Mm-hmm. I think gone are the days where, there are people who used to buy properties off plan and then try and flip them before they were built and, that kind of thing. I do think those times are over. Mm-hmm. If you take a long-term view, you will always perform well with property, and that kind of ties in with your long-term objectives as well. So what are you actually investing for? Is it for your retirement? Is it setting up a fund for your kids? And when you have that in mind when you're making a purchase, then that means you can buy the right property for you, and be able to make the kind of right amount of returns that are right for you.
Absolutely. And just to kind of touch on that point again, Ben. I wouldn't say amazes me, but time and time again, we speak to clients who want to invest in property and they're not very familiar with their kind of long-term objectives. We always advise all of our investors to think long and hard about exactly why you're choosing to invest in property. Is it to build a retirement fund? Is it to build up a pot of money to fund your child's education, or is it simply that you just want a better quality of life? But take some time and really think hard about that, because the type of property you invest in and the decisions you make thereafter, they need to help add value to your journey, and they need to help you get to where you want to get to. So yeah,
absolutely, 100%. Because quite often when I ask people that question, they'll say, "Well, I want to make as much money as possible."
Yeah,
and it's like, well, obviously we all want to make as much money as possible, but how do you want to do it? Is that built up in your kind of long-term equity within the property, or is it a more of a you're looking to make some higher returns now, more on the income? All of this is very important. So before you buy a property, do think about all of these things.
Absolutely. Last one here, we put negotiate with the vendor. Not so much in relation to capital gains tax, but let's just say in relation to stamp duty. Then one way to negate the increase in stamp duty is to try and negotiate with your vendor or with the person who's selling you the property. A lot of developers are kind of factoring in stamp duty at the moment. Some are, some aren't. But yeah, look, that's also a very viable strategy that investors can use.
Absolutely.
So look, just to summarize taxation, stamp duty, yes, it's gone up. If you're looking at high value properties, yes, you're going to take a hit, but plan accordingly. If you're looking at lower value properties, then you're not going to be hit so much. Now we're going to talk to you about affordable housing, because as well as concentrating on taxation and stamp duty, the Chancellor also announced a whole heap of policy and decisions around affordable housing. There seems to be a big push around affordable housing now. A lot of money has been made available by the Chancellor. And really what they want to do is speed up the rate at which homes are being built in the country. Historically, this has been a huge problem for the government. Time and time again, we've seen incoming governments pledge that they're going to build X amount of homes in X amount of times. And time again, unfortunately, we see them fall way short of the mark. In fact, the deficit of new homes being built currently is immense. Target of 300,000 homes every year, and we've been building
170 or something like that. So there's been 120,000 pounds.
Exactly.
120,000 unit shortfall. For about the past 30 years.
Correct. And so, like with all the governments that have preceded the new Labour government, they've come up with these kind of big, illustrious plans to build so many homes. And Ben's going to talk to you a little bit more now about that and what it means for us property investors.
Yeah, exactly. So just kind of quickly looking over the kind of main bullet points, there was obviously a £5 billion package, that was made available to stimulate the supply of new homes. How that will actually be spent and how that's being allocated is still within the details. So again, as Sanjay was touching on, most governments have had a big, desire and drive to try and create more homes, but how they're actually going to do it is a bit questionable. I mean, I know that when they first came to power in their manifesto, one of the big things was releasing brownfield sites from the green belt. So not basically greenfields like farmland or natural kind of sites being made available for housing, but say a car park that's surrounded by green belt. That used to be very, very difficult to build on. But releasing that, I think, is generally quite a good policy. And then
just before you move on,
of course.
Talk to me a little bit about how what issues have happened historically with planning, and why there now seems to be a big push on kind of not relaxing planning laws, but certainly loosening them a bit.
Yeah, exactly. So the way that the Conservatives generally felt with planning was trying to make planning much more localised, so basically give power to local people to basically control what was built in those areas. But obviously, naturally, what happens is when you give more power to local people about what gets built in their area, generally they're going to try and stop any kind of development because they obviously like the area the way that it is, and they're going to be putting forward large-scale housing applications. So what that's meant is that actually over the past, kind of 15 years, is that that's actually exacerbated the housing supply because basically local councils have the power to, first of all, stop large-scale infrastructure projects and also large-scale housing projects, but then also can be a bit more pernickety when it comes to smaller-scale projects as well. So what Labour are looking to do is basically actually kind of take away the red tape, so to speak, and also take away the strength of local councils in basically or basically planning committees in basically deciding what kind of developments can be built in that area, in the hope that will spurt growth and the number of developments in areas, which I think is generally quite a good policy, because some of the reasons why certain developments have been rejected over the past 15 years is completely preposterous. And then kind of moving on to the kind of other sort of plans that they've got. You've got the £3 billion support package for private developers as well, and within the build to rent sector. So how does more affordable homes and all of these packages, if they were to come to fruition, affect property investors? So it's very questionable, because obviously the very basic kind of thing around property investing is like with all kind of commodities, it's supply and demand. So obviously, theoretically, if you have a much higher supply, then it means that the demand per property is lower, so then the increase in property price will naturally come down. Now, how much this package will actually slow down the growth of property prices in various areas is very, very questionable. But then again, on the flip side, these properties that are being built are affordable homes. They can only be made available to owner-occupiers. They're not going to be made available to investors. So again, what does that mean? It means that the supply of potential rental properties coming to the market will actually be exactly the same as it is now. This will not affect that. And then also the number of properties that investors can potentially buy for investment will be unaffected. So it actually could have another effect where you have all these properties coming online and people buying the affordable houses because they're first time buyers, but it doesn't affect the rental market in any way whatsoever. So actually you get higher rental returns. So again, we don't know until 5 to 10 years down the line, but those are the kind of things that could potentially happen. I mean, I know it could also mean lower yields due to higher competition, but again, this housing is more for the affordable sector, so you won't get investors purchasing these properties.
So what can we as investors do then to avoid getting lower yields?
Yeah, exactly. So if you obviously buy in areas where there's a massive undersupply within the markets anyway, it doesn't really matter how many houses they're going to build in those kind of areas, there will always be an undersupply. So if you buy in areas where there's good lack of good quality homes, then that will obviously be areas where you have kind of good kind of protection against your yields being affected. Furthermore, also look at areas where there's maybe a kind of angle. So kind of a reason why there will be much more demand moving forward, say like a new kind of like factory being built, or new businesses coming to an area, so on and so forth. So if you do that, then generally the provision of new affordable homes won't really affect prices in that area. They will still increase. Absolutely.
And the obvious one is to look for areas where there is a short no affordable housing, or no new affordable housing projects going. I think the key here really, and as we've put here, is to take your planning seriously, and plan way ahead. Do all the right research, check out the local areas, look at the council portals or the planning portals to see what projects are coming to fruition soon, or what coming out, or what we're going to be launched soon, and then make your decisions accordingly. So that really kind of sums up the affordable housing. In summary, was the budget as bad as what everyone made out, Ben?
Absolutely not. So it wasn't. I mean, especially from a property perspective, nowhere near as bad as it could have been.
Yeah. Yeah, absolutely. I think that definitely it very much unsettled investors in the run up. But what we've seen now is the kind of dust has settled. The investors are coming out to invest again. And look, let's face it, there was also a whole heap of other things the Chancellor spoke about. I mean, inflation is coming down now.
Yes.
It may have increased a little bit over the last month or so, according to recent figures. But in the main, inflation has come down. It looks likely that the government are going to hit their target of 2%. As a result, interest rates have been lowered. The base rate came down from 5% to 4.75% not so long ago. There is talk of more rate cuts in the future.
Yes.
And so what that's done, alongside the kind of changes the budget's made, is it stimulated this new kind of interest and this new energy into the market. Certainly over the last 2 or 3 weeks, we've seen a massive uptake in business. Lots more investors are talking to us. The cost of borrowing has become cheaper. And there seems to be a lot more optimism in spite of all of these the changes that the Chancellor's made. There's a lot more optimism. The economy seems to be in a good shape. And so it's important not to forget that, and not to get caught up in all of these legislative changes, and remember the basic market fundamentals. And that's supply and demand. Interest rates are coming down, and property prices as a result should increase.
Yeah, exactly, absolutely. And just touching on that point, I think you can get a bit overwhelmed by kind of doom and gloom and negative press and that kind of thing. But in the end, if you bought in 2020, even with everything we've had since, your property would be worth more. We've had 4 years worth of rent, so now is the time to buy.
Absolutely. And there's the summary that we just spoke about. So that kind of brings us to the end of our budget roundup. As always, if you've got any questions, please feel free to drop us some questions in the chat. We will endeavour to answer them. But we're going to move on now to a very exciting launch that's taking place here at Opulent this week. It's in line with kind of where we're going as an organisation. I think we kind of over the past few years heavily focused on the northwest of England. And in particular, Manchester, Liverpool, Birmingham. And look, there still seems to be a lot of interest, certainly from our investors, around these locations. Now, some may argue, Ben, that the right time to invest in these locations was maybe 10 or 15 years ago, when property prices were rock bottom. I mean, if you look now, you fast forward 10 years, you look at the prices in Manchester now.
Yes.
For a 2-bedroom apartment, you're talking about 350, 400K in the centre of Manchester, which is, almost on par, if not more expensive than what prices in London cost, in the outskirts of London.
Yeah, of course, absolutely. So, we've got new project that we have done a few sales on, but the one bed start from £350,000, which is actually more expensive than a project that we do have on the outskirts.
Absolutely, absolutely. So we as an investment company have always been very big on the fact that our investors should be looking at emerging markets, frontier markets, markets that aren't buoyant currently, but have all of the different ingredients that make a successful investment going on. So what are those ingredients? We're talking about regeneration. We're talking about population growth. We're talking about extensive kind of government funding being ploughed into the areas to rebuild the local economy. That's kind of what we've always told our investors. And we believe now there's an area of the UK that is ripe for property investment. It's an area that has been deprived for a long time, underfunded, and what we're seeing in this area is that prices are cost effective. I won't say cheap, but they are cost effective. The average price of a property in the area we're talking about, which by the way is the northeast of England, so not the northwest, the northeast of England, the average price of the property is 100 to 125k. Whereas if you look at the northwest now, you're talking about 200, 250k in Manchester, average price of the property. So we believe in identifying these areas for our investors where they can invest now, buy property at a low price, and then when all of the hype happens, when all of the mainstream amateur investors come, you then look to sell, because then you would have made a nice profit, as you would have bought low and you would have sold high. So we're focusing more now on the northeast. It also ties in very nicely with the recent stamp duty changes. The stamp duty on a property price of 125 grand, as I've already illustrated, is a lot less than some of the properties in Manchester or Liverpool. So what do we have for you? Our new project is called Parsons House. It's actually located in an area called Washington, and that is a suburb of Sunderland. The particular project that we have is Parsons House. It's 40 apartments. It's a brand new building that's recently been completed. It hasn't been occupied, and it is very, very well located in Washington, as I'll go on to show you in a little while. It's extremely close to a number of big businesses. Now, whenever we look at our projects, one of the things we always look for is industry and commerce around the project, because ultimately all of these businesses, they have staff, the staff need places to stay. And what we found in this particular area, guys, of Washington, is that there is a distinct shortage of high quality contemporary accommodation. So there's a little bit about the project. What we're talking about here, a high level overview, is we're talking about yields of up to 7% net on a long-term let. The building does permit short-term lets. We've done some analysis. We've spoken to a number of short-term let providers. There's one in particular that is very well established in this area, and they are forecasting net returns of 11% there or thereabouts, which is an amazing return on your investment. Now, the reason why they're forecasting returns of up to 11% net is, as I've already mentioned, there is a huge shortage of modern contemporary new build accommodation in the area. If you go onto Rightmove, you go onto Zoopla, all you can see is old, decrepit accommodation that, put frankly, isn't really the type of accommodation that corporate employees really want to stay in.
Yeah, exactly. And then just kind of following on from that, who are the people who are going to be filling these corporate lets? So in that area, just touched on it, there is Nissan. So basically the UK's largest car factory, which produces 1/3 of all cars manufactured in the United Kingdom. That's literally a 3-minute drive from this development. So you have 6,000 employees currently. However, they have just invested another £2 billion into building a new kind of electrical vehicle plant, and there are also other businesses as well, kind of located within the area that will come on to as well. I think just want to touch on what the prices are.
Yeah. Well, look, just before I do, as well as Nissan, there's a whole heap of other companies very, very close by, within a 5 to 10 minute drive of this development. You've got Amazon, Rolls-Royce, BAE Systems, DPD. There's a whole heap of companies around it, but I'll talk briefly about the investment highlights first before we get on to that. So we've got a studio apartment starting here at 79,950. 2 beds actually start from 103k. The 90k one we had is already sold, so the cheapest 2-bed we have is 103k. Which is fantastic value if you ask me. I wouldn't have even thought that you can build apartments at cost for that price. But we have managed to agree very favourable pricing. In fact, these particular properties are approximately 20% below the market value. We have an independent valuation done from a valuer. And they are saying that the prices we are selling these properties at are at least 20% what they should be sold for. So what that means is effectively on day one, you're walking into a scenario here where you have instant equity of 20 to 30k. You could buy this property tomorrow, complete a month later, and then sell it 2 or 3 months after that and make quite a tidy profit in doing so. They're also completed and ready to occupy. That means that there is no development risk. We're not talking about off-plan in the somewhat precarious times we're in. We're talking about apartments that are all done, ready to move into, and can effectively provide an immediate income. Yields, as I've discussed, 9% growth, 6.5 to 6.9% net on a short term, higher on a long term, higher on a short term. It's going to be a 999-year leasehold, so effectively a share of freehold. There's parking available on site, albeit a slight additional cost of 5k per space. Service charge, it's a brand new building. There's not much that's going to go wrong. So we're looking at £1.89 per square foot, which is again very, very reasonable, and will mean slightly higher yields for investors. And short-term lets here, as discussed previously, are permitted.
And also just very quickly on that service charge. So I mean, another kind of way that we're looking to improve the service to our investors as well is that with these new properties, in terms of the freehold, so rather than it being the developer moving forward, we are now going to be taking on the freehold and basically running the block on behalf of our investors, because we're fed up of selling people properties, and they say the service charge is one thing 1 year and then it goes up incrementally every year. Whereas what we want to do is provide the best service to our clients. So we'll be controlling the freehold and basically running it on behalf of our investors.
Absolutely. I think the danger is in that type of scenario, certainly what we've seen in the past is once a developer has sold all of the properties on that block, he will then almost be not so bothered about what the service charges are. Why? Because he doesn't need to pay them. He's not going to be as bothered about how the building is run. Why? Because he doesn't need to put anything right. It's all you guys as leaseholders and investors that need to pay for that. And so, as Ben quite rightly said, we've had enough of this. We absolutely have had enough of this. Not being in control is a big thing. Leaseholders, it doesn't matter whether the lease is 100 years or 999 years. If the developer owns the freehold, then there is always the risk that you don't have the control, and that service charges can quickly spiral out of control, and that will then eat into your net yield.
And also, quite often what's happened is the developer will then sell the freehold to a specialist investment company.
Exactly.
Whose basically raison d'etre is to make money.
Absolutely.
And, again, we're completely fed up with that.
Absolutely.
So we're controlling it on behalf of our investors, open and transparent, going through all of the costs every year.
Absolutely.
So that's what we're going to be doing.
Absolutely. And guys, look, that is a huge benefit for you guys as investors. Ultimately, our end goal is to make sure our investors are happy and that they come back and purchase more property from us. And one of the biggest ways we're going to be able to do this now is by running the block on your behalf, making sure there's no unwanted surprises, or service charges aren't going to double or triple like we've seen in some instances. But we're going to be in control. We're going to be managing the block. And we're going to ensure that our clients maintain a good net return on these properties. Here's some pictures for you on the actual project. I think what I'm going to do now also is I'm just going to run a quick video that shows you. There you are. So I'm sure you'll agree, lovely project, built to a high specification. There's lots of useful amenities on site, which I'll talk to you about in a minute. But yeah, it's a very nice project and has recently completed and built by a very good developer. So let's now move on and let's talk to you a little bit more about the Northeast itself. I know we've spoken a bit about it already, but the Northeast is an area that has been historically kind of deprived, I guess, of funding. Yeah. I remember going to the Northeast 5 or 10 years ago, and you'd kind of be looking at your clock trying to get out of there as quick as you can. But we went up recently, and we were very, very pleasantly surprised at the amount of regeneration happening in the Northeast now. Lots of money being pumped in through various different funding initiatives, and actually, what we're starting to see now is prices starting to increase, whereas historically they were declining. Now what we started to see, in particular in areas like Sunderland and Newcastle, are not only the price of the properties increasing, but the rents increasing as well.
Yeah, exactly, absolutely. And also, because with this development, it's actually, whilst Washington is a suburb of Sunderland, it is still also a 15-minute drive from the centre of Newcastle as well. And Newcastle has, seen slightly more regeneration, but now it's Sunderland's turn. And Sunderland is really the city that's seeing massive transformation.
Absolutely.
Because when you have a look at, first of all, the Riverside Development Project, which I think is the area that used to be the kind of old dock works within Sunderland, so that, again, 1,000 new homes and £42 million project. You also look at the Strategic Transport Corridor, which is exactly where Washington is located. So that's basically part of the Nissan factory and that wider kind of industrial park. So that's obviously a £1.5 billion project. And then also, the International Advanced Manufacturing Park, which again is part of that kind of area where, building more office space and basically attracting more jobs to the area.
Absolutely. Now, the town with the second highest population in Sunderland is a town called Washington. Washington is, as Ben mentioned, kind of equidistant between Newcastle and Sunderland.
15-minute drive to each.
15-minute drive to each one. And it's also an area that has been heavily focused in on industry. And lots of big companies are based in Washington. And as I mentioned before, there is quite simply not a lot of places for the employees of these companies, especially the ones tripping in from different areas to stay.
Yeah, exactly. And also, when it comes to short-term lets as well, you're obviously going to be getting a big, drive from Rolls-Royce, BAE Systems, all of these different companies. But the big one, especially, is Nissan, because the way that Japanese companies operate is that they like to get management from Japan to come and oversee the operation.
Absolutely.
So you have a very high number of people who are looking for short-term rents in the area, which is why when you look at Washington, there is a very high number of hotels.
Yep.
But there's actually no kind of high-quality new build flats for them to stay. And that's why with our short-term recommended short-term let management company, we've already had inquiries with that, we'll blow that 11% net out the water. So,
Absolutely.
So, and then, kind of looking at this kind of general rent. And as I said, Washington is yet to see the really big increases in rents. But, rental yields in Washington, you're looking at 7 to 9%, entry cost of 120,000. Compare that to the city centre of Manchester, 4 to 5%, 4 to 5% rents, entry 250. As I said, in some of the higher end developments, it's a lot higher than that. And London, one bedroom flats, you're looking at 500,000. Lucky if you get a 4% rental return.
Absolutely. So here's a map of the development showing all the different companies. And in relation to where the development, as you can see, you've got Rolls-Royce, approximately a 12-minute drive, about 5-minute drive even. And then you've got Nissan, which is approximately a 12-minute drive away, about 3 miles from the development. Now, Nissan, I'll go on to talk about now, actually. But Nissan have recently announced, not recently, actually, it was a little while ago, but they've announced a proposed investment of £1 billion into a new EV battery plant, where they're going to be manufacturing a number of EV vehicles. They initially announced a £1 billion investment. Then they decided to double that investment to £2 billion. This EV plant is well underway. And another thing with Nissan is it's not just Nissan who are based in Washington. Obviously, you've got all of the supply chain companies.
Yeah, exactly. As well as those other companies that we recommend, but it's mainly the supply chain. And in fact, the Nissan factory alone supports 30,000 other jobs within the area. Yeah. And it's the fact that you've got all these other companies. So it's not just that 6,000, it's all the other companies in the area. Because obviously, making all the different parts of the cars and so on and so forth.
Absolutely, the tyres and
exactly, because the actual car plant itself is just assembling it. They don't actually manufacture all the other little bits.
Absolutely. Right, so here's some financials and how it all works. We've used a typical 2-bedroom apartment, £112,000, £2,000 reservation fee, which then gets deducted off your 20% on exchange, which is £20,400, and then the balance due on completion. Legal fees, £1,250, and the stamp duty is £5,600 if you're a UK buyer, slightly higher if you're from overseas. Total cost to purchase, £118,850. On a standard long-term let, you're expecting to achieve £9,540 based on a £795 monthly rental income. That leaves you with a gross rental yield of 8.52%. You take off your service charge, you take off your management fee, which is 8% if you use Opulent, and then you're left with a net yield of 6.78%. Which is pretty healthy in today's market, man.
Yes, absolutely. And kind of going on from those figures that we were saying earlier, comparing, Washington to London and Manchester, much higher returns.
Absolutely. So that kind of brings us to the end now. Just to finish up on this project, we launched this project beginning of last week, I would say, not even tail end of last week. Already, we've sold approximately half of the 40 units that we've got to sell. They've been sold very, very quickly. Investors like the fact that it's completed. They like the fact that there's no development risk, and they like the fact that, in theory, they can get a return up to 11% net, which in today's world is very, very good return on your investment. So guys, look, if any of you want to discuss this in more detail with one of our consultants, or you'd like to get more information on the project, then I'm going to now publish a one-to-one consultation offer on your screen. By all means, feel free to book a consultation with us. We'll gladly run you through all of this investment in more detail. And if you wanted to speak to us about anything else related to the budget changes and the takeaways from that, then just, by all means, just book a consultation with us, and we will get back to you as soon as we can, or book a time that suits you. That then, ladies and gentlemen, brings us to the end of today's webinar. Hope you found it useful. We're going to now have a look at some of the questions that we've received. Sal, okay, you've answered that question already. Official valuation, you'd like to see the official, one of our investors, Sal, would like to see the official valuation for the actual development. We have a copy of that. More than happy to send that to you, Sal. By all means, we'll forward you a copy of that. In there, you'll be able to see the true valuation. And what you'll also be able to see is a breakdown of the valuation for each apartment. On average, the 2-bedroom apartments have been valued at between £145,000 and £150,000. We're selling them for, between £103,000 and £125,000. So genuine market discount.
And then, you can see this message from Steve saying, well, if you're going to invest in the North East, why wouldn't you just buy Newcastle? And, that's a fair point, because obviously, Newcastle, it is the biggest city in the North East, and I would say, has definitely had the biggest amount of investment thus far. But again, when you look at the kind of localized conditions for Washington and what's driving the potential rental growth, then you're getting in kind of ahead of the curve, because the people who got in ahead of the curve in Newcastle was probably 5-6 years ago. Whereas with Washington, with the increased jobs that's being announced from Nissan and all the other companies as well, you're really, basically getting in before the other investors. You're buying Bitcoin at £800 a Bitcoin, not buying it at £70,000 a Bitcoin.
Absolutely. So you're buying low and you're selling high. Got a question here from James. James would like to know, typically in our experience, how long should investors be planning for their purchase before they make it?
So, again, this kind of comes down to personal preference and also whereabouts you are within your journey. So, again, I think there's a lot of people who kind of fall into the trap of over planning, where they kind of need to try and wait for the right investment, and then they end up never investing because nothing ever is absolutely perfect. But I think you can generally, if you know that you are ready to buy, you can make a decision within 3 to 4 weeks. Assess the market, do your research, speak to everyone who's selling the different properties, ask difficult questions. So I'd say that would be about time. What would you like to add to that subject?
I think it very much depends on the person and the investor, all right, and how readily available all the information they need is there. I would say typically 4 to 6 weeks. But I think you kind of summarized it well there. Another question here from Abdul. Abdul's asking us what the sale process is, or what would happen if he wanted to purchase one of these properties here at Parsons House. Quite straightforward, Abdul. I don't think you've purchased a property with us before, but first of all, we will make sure that you understand the opportunity You've understood all the risks. You know what you're getting yourself into. Once that's all been done and you decide to reserve, it's a straightforward £2,000 reservation fee. We'll send you out a reservation form for you to sign. You sign that, you return it back to us. Once we receive the £2,000 reservation fee, we'll then move it into legals. We have a very well-staffed after-sales team here that will help guide you through the after-sales process. They'll introduce you to the solicitors. They'll introduce you to anyone else, mortgage companies, etc. And then once that's done, and you're happy with what the solicitors provided you with, you'll then look to, if you're a cash buyer, you would most probably exchange and complete at the same time. If you're a mortgage buyer and mortgages are available on this project, you would exchange with 20% and then complete, a month or two afterwards once you've got your mortgage offer, you pay the balance of 80%.
What I was going to say, because they asked that question about whether mortgages are available. So whilst obviously you do complete 20%, there is a possibility that a 20% deposit would be accepted by the mortgage company. Mm-hmm. But I would still always say with people, do expect to pay 25%. Yeah. So put an extra 5% of your own money, get a mortgage for the rest. Because the thing is that the lower deposit you have, generally that also means the higher interest rate you pay. Mm-hmm. And to obviously make things stack, because whilst obviously interest rates, they've started to come down, they haven't got very, very low yet. No. So that's why never overstretch yourself. Yeah. Make sure that you put in a decent deposit, and that will mean that you get good cash flow from that asset moving forward. Absolutely.
And then once you've completed on the property, the work for us doesn't stop there. We also have a lettings and management business that can manage your property. We will make sure you get all signed up with that. We'll then go out and find your tenants. We'll screen your tenants. We'll make sure we're getting in good tenants that are likely to stay there for a while. We'll vet those tenants. We'll collect the rent from those tenants. We'll provide, biannual inspections of the property, and then we'll pay you your rent. One-stop shop that kind of takes care of everything. You'll have one point of contact throughout the process. And Ben, did you want to add something to that?
Oh, no. It's just moving on to the next question from EK about what happens to my deposit if the deal falls through along the way due to mortgage or legal. So essentially, the reservation fee is £2,000, which basically takes the property market as you explained, and that's when you go through the process. Now, realistically, you'll have already had your mortgage offer, and the mortgage company will have confirmed that they're happy to lend on it before you pay that 20%. Right. So you're not going to be paying that 20% until you are very certain that deal is definitely going to go through. Yeah. Now, if for whatever reason you weren't able to, if the mortgage offer didn't go through due to your kind of personal circumstance or, that kind of thing, so that £2,000, it is held with us. So, technically it is non-refundable, but obviously on a case-by-case basis, if it's out of your control, we hold that, so it would be funded back, so.
Absolutely, yeah. And then look, wherever possible, we don't like seeing reservation deposits being taken from developers. We'll generally do what we can to ensure that. But going one step further, what we'll also do is make sure that you fully understand everything beforehand. You know what you're getting yourself into. So the likelihood is you've considered all aspects and don't change your mind. If the developer for some reason changes his mind, will be very, very unlikely because the properties are complete and within 4 to 6 weeks you'll be the owner of these properties, then 100% then we would get your reservation deposit back. Great. Well, that brings us to the end of today's webinar. Thanks very much again for everyone that's joined us. It always overwhelms us how many people join these webinars from all different parts of the world. If you want to discuss any of what we've talked about today, get in touch with us, book an appointment to speak with one of the consultants, and we will be able to help you from there, really. So thank you for joining us, and we look forward to seeing you on our next webinar.